So we've got Cameron Dawson on tonight. She's saying not to get spooked and to keep long-term goals in sight. I believe in that too. I always look into the long term. That's how I choose to invest. We've got another red day in the market today. We've got the QQQ down about 1%, and we've got the SPY down 0.75%. Big tech's down 2 to 3 times that. But anyway, if you guys enjoy these videos, hit the like button and let's jump on into them.
The state of stocks and why some say this correction is not over. NewEdge's Cameron Dawson among those making that case. She's here now at Post 9. It's good to see you again. We should also note, as we're at the lows of the day, the Dow has breached its 50-day moving average. So we've had some technical aspects to this as well. Why do you argue today that this has more to go?
Well, the confluence of evidence would support that there is more to go because of seasonality for the first point, meaning that we're in a bad seasonal stretch. September's the worst month. We also know that momentum has turned decisively negative in the near term on a tactical basis. And then breadth, meaning the number of names that are trading above their 50-day moving average, it's not washed out yet. So there's still likely some churn and digestion to go. We've crossed under the 50-day. There's still likely support at that August 2022 high around 43.25, and then we'll see how we deal with that support level.
What do you make of this alleged change in mentality from what was a decidedly buy the dip market to what has now become maybe a sell the rip market?
I think the first thing to acknowledge is that it is very tactical. So as a strategic long-term investor, this shouldn't really change from what your plan is. But I think we can put it in the context of the 50-day. Prior to this sell-off, we were trading above the 50-day. Every time we traded down, April and May, we bounced right off of it. Today is different. We're likely going to be in a period of a little bit lower highs, lower lows, as you see people sell into strength.
You want to comment on the idea that, until Apple, biggest stock in the market, which is down 11% this month. It's the worst mega cap this month. And the 10-year yield, which continues to creep higher. Until those two things stabilize, we're going to be having similar conversations.
Yeah, I think that is hypercritical. And if you look at Apple alone today, that broke below its 100-day moving average, which means it puts its 200 days in sight for the next level of support. And Apple being such a behemoth and such an important part of market psyche, it's hard to imagine this market pressing much higher without the contribution of Apple and the other tech names, which have been trading weak as well.
Yeah, Joe.
If you guys know anything about technical analysis, and you also know about how big Apple is weighted in the S&P 500, first you know that Apple is a very large part of the S&P 500. And second, if you know about technical analysis, there is a huge, about 7% drop. And then we've gone sideways for 5 to 7 days, and now we've just broke that low. That normally means we have another leg about the same exact length. That put us down anywhere from 13 to 17%, guys, on Apple. So, and that's going to drag the entire market down. So regardless of what's happening with the economy, if Apple's got somewhere to go, it's going to drag everything down.
Terranova of Virtus is with us as well, a CNBC contributor, of course. You want to give us your sort of read on what's happening here? As we've come on the air, we've breached the 50-day, as we said, on the Dow, and we're a little, even more unsettled.
Mega caps and technology were the leadership. It was the very first time that we've had leadership in the market since the onset of the pandemic. We welcomed it. You can't lose leadership and expect the market to fight up against what is obviously a historically weak seasonal period.
Yeah, September and October.
It's the month of October. Cameron mentioned Apple breaking down below the 100-day moving average. It's just not Apple.
This talk of August and September always being a bad month, it's a self-fulfilling prophecy. If you believe that and everybody with money believes that, it's going to continue to be that way. There's nothing special about August and September for a long-term investor. It's no different. If you invest every single week, you're going to invest every single week. If you invest once a month, you're going to invest once a month. It should not make a difference. If they are going to sell it off in August and September, then we'll just keep putting it in at better and better prices, guys.
You also have Microsoft and Tesla. So, if my math is accurate here, that's probably 15 or 16% of the overall S&P 500.
Well, Apple alone is like 7.
Right. And so Microsoft's somewhere 6.5%, and Tesla's right below 2%. So, you're talking about close to 16% of the S&P trading below its 100-day moving average. We're in that seasonally weak period. And I think the question becomes this. If you were a 2022 bear, you believe this is the beginning of a deeper decline back towards the October lows.
Well, because most of the 2022 bears have been 2023 bears.
Okay.
Because they missed it. They weren't positioned correctly to take advantage of the big run in mega caps that we had, which have saved the market.
Correct. And if you're a 2023 bull, which I am, you believe that ultimately at some point, not now at all, some point as we move to the back half of September into October, there's a tremendous buying opportunity. If you go back, Scott, over the last 33 years, there's been 10 instances in which the S&P 500 in the first half of the year rose by 10% or more. In each one of those 10 instances, the second half of the year was positive. If, in fact, that is going to be the setup as we move into the fourth quarter, you're going to have one heck of a chase for performance because all those 22 bears, they have to come around at some point.
So you're part strategist, you're part historian, you're part technician, right? You view the market through so many different prisms. What about the one that Joe puts forth?
Well, I think to put another point to Joe's is that this correction, as of right now, is not about growth fears. And that's very different from 2022. 2022, we saw EPS revisions go down 10%. We saw the weak recession or the weak GDP quarters that we had. So people had a kick up in recession fears. You don't have growth fears when Atlanta Fed GDP now is at 5.8%.
Right.
This is about yields and this is about valuations, which is why the highest valuation parts of the market are underperforming.
Because I'm so glad you went there because of the idea that the whole reason we got here in the first place was multiple expansion from the very names in which you're referencing that have pulled back over the month of August.
Exactly. And if you look at for the S&P 500, the entirety of the move this year has been multiple expansion, anticipating a better earnings environment. The thing that has been the most surprising is that despite the fact that we've had a recession call or no recession, no landing, a boom, a banking crisis, earnings estimates for the entire year have been static. They haven't moved. And so all the volatility is driven by valuation and multiple, which makes it susceptible to moves in yields.
Well, static might be the new up, though, right? I mean, they haven't gone down.
Yes.
Which is a big part of the story. Let's be honest, right? They haven't deteriorated to the point where some thought they might. Flat is the new up, maybe, for earnings for a while.
Yes, and I think that that is the big contrast to 22, which was all about earnings coming down. So I think watching 2024 earnings to see how, if they get revised higher because of this GDP growth, that can offset some of the multiple compression. But we do have to remember is that we're pressing into this new high for yields, real yields, and at near peak multiples. That is a challenge for these high-flying names.
So there obviously does seem to be a reoccurring, consistent thesis that we are going lower. We have room to now fall. But as you saw on some of those slides on the side, even with this 11% pullback this month in Apple, it's still up, 38%, I think that said, this year? I think you'll be all right. If it's fallen up, if you started this year investing and you're up 38%, I don't think you're really too hurt that you've lost 11% this month. Now, obviously, if that stays like that and it keeps getting worse, that's going to be a big deal. But it's in the biggest company in the world. If anything comes back, Apple will come back. They're doing the same thing they do every single time that they want to put some money into the market. The economy's terrible. The growth is behind them. They've gone up too fast. The economy's crushing. We're now worried about rate hikes when we haven't been worried about them for X amount of time. They pressure the average consumer into all these different directions of buy, sell, buy, sell. And they just sit back and make a killing, guys. We got to be the ones that sit back and make a killing. We got to ignore all the talking and look at the charts. Look at history. When you see massive dips in great companies, what do? You buy the dip. And if you've looked at it every other time in history, what would you have done? You would have made out on a killing. You would have made out with some money. I don't think it's going to be much different this time. As always, guys, if you enjoyed it, please hit that like button, and I will see you in the next one.